pretty important class because we're going to get into derivatives today. Real quick, finish up. I can do a whole lot more in portfolio management, but that's not what this class is. It's just real high level what we did last time. So you need a philosophy. There's so many philosophies out there. What I recommend if you're going to be interviewing for jobs is come up with one or go steal one or the other. The most famous one is GARP, growth at a reasonable price. I'm kind of a corp, quality at a reasonable price, but some strategy that you can articulate. But if you can't find one, there's plenty of them out there. You just type investment pitch book in Google, and a bunch of them will come up, and you just look and see what their strategy is. It's usually kind of a pyramid kind of thing. They start with the universe, and they have some kind of screening, and they do some other kind of level of screening, and they get down to their buy list. But you want to be able to articulate, what's your philosophy? I believe stocks, like for me, if I can find high quality stocks that are inexpensive, and to me, high quality doesn't just mean they're growing fast. It also means they have stable earnings. They don't have overuse of debt, those kind of things. Also, high quality is what Warren Buffett talks about, conservative accounting. They're not trying to cook the books with accruals and those type of things. So you can base it on fundamentals. You can base it on quality, valuation, probably some combination. Some do technicals. I was showing my security analysis class. There was a technical analyst portfolio manager who came to UTSA. He was from Wellington. Really aggressive guy. Boy, just high octane. A guy named Frank. We were impressed. He was very confident. That mutual fund's been shut down because of horrible performance. But for a while, he had a mutual fund. It just materially underperformed. I don't know many mutual funds that are 100% technicals. There must be at least one out there. Thematic, I've seen a lot of thematic investors. Usually it's tied to the economy. They think they can predict the economy, and they're going to say, hey, we're expecting this type of economy, so we want these type of stocks. And then there's stock pickers, and I've seen both. I remember interviewing 2 real estate investment trust managers. One was top down, one was bottom up. The top down said, this is the part of the economy you want to be in. This is what interest rates are doing. Therefore, we want to buy these REITs. Stock pickers they knew the industry, and they just picked companies based on what they knew. So that's your philosophy. Then you have to have a process that finds those stocks that meet your philosophy. So if you're doing corp, then you got to define quality, and you got to find reasonable price, and then you got to go find those companies. And then construction, and boy, construction is something you've got to think a lot about. How are you going to weight? You're going to put them all equal weight. You're going to somehow size it up based on your confidence. You're going to put trading costs into it. So it gets a little tough. I'm not going to build efficient frontier in this class, but if you take my risk class, if you do it. And in risk management, it's really 2 things. Risk management is your sell discipline, and then your rebalancing. How often are you going to rebalance? And if someone asks you about your sell discipline, you better have a very clear, articulate answer for that. You can't be wishy-washy. My favorite is I buy a stock that's, say, consumer staples, and my stock's down 25% and consumer staples are up 5%. I must have messed up. So I might say, hey, if there's I won't do it against the stock market. I don't like the ones that say, hey, if the stock falls 10%, I'm getting out, because if the stock market falls 20%, that might have been a really good investment. But I do it relative to the industry. If I bought this internet stock, it's down 15%, but internet stocks are actually only down 5%. I missed it by 10%. I'm going to sell. Some say we sell if it hits our price target. That's the most wishy-washy of all, because what do? You just keep changing your price target. What drives firms like that? Ego, more than anything else. They don't want to sell a loss, right? Because if you sell a loss, you admit you're wrong. So they say, oh, we adjusted our price target, and we're going to, whatever. I guess if you have a loss, you wouldn't be hitting your price target. I'm going to talk about a better way to sell with price target when you get into to calls. And then rebalancing, you can actually look that up. Go Google it. The optimal rebalancing strategy, and there's been many academic papers on that. That's pretty important. If you're Kathy Woods, I would recommend you never rebalance. If you're Kathy Woods type and you're just looking for the next breakthrough innovation, you buy it and you just hope it goes up 80,000%. Rebalancing works because a lot of those stocks are going to go out of business. So you need the one up 40,000% to offset all those negative 100%. So to me, you may not rebalance at all. And there is some strategy to that. So this is what you need to be able to articulate in an interview, these 4 pieces, but go find some. If you want some examples, I have some that I took with me from USAA, but boy, they're old because I retired 10 years ago. One of the guys that worked for me, this was his thing. Boy, he collected these pitch books. He knew all the companies, just incredible. He's not at USA anymore, but boy, that was a great loss when we lost him. I think he had all the pitch books at home in his garage because he loves reading this stuff, different strategies. We had him on our selection committee just because he knew it so well. But there are plenty of them out there. You have to be careful. A lot of them are VC firms, venture capital. You really want a true stock manager that's buying stocks and not doing anything too crazy. So GMO is a good one to go to. Their site's pretty easy to get through. If you register, they are quality at a reasonable price plus momentum. That's their 2 strategies. But it's okay to steal someone else's when you're doing an interview. Just make sure you hide it well enough. They don't hear Ken Fisher or Jeremy Grantham talking. It depends. If you're talking to human resources, they won't know. But if you're talking to finance, yeah, they'll say, "Hey, you just explained." So, what is Warren Buffett? Does he care about fundamentals? Does he care about quality? Care about valuation? What does he want? He wants good, solid businesses that are well run, cheap and rich. It's kind of hard for him because when he buys a business, it's going to definitely move the price. But he buys pretty boring firms. I don't know if he still has Dairy Queen. I haven't eaten at a Dairy Queen in years. I don't know what the cash flow there is. Fruit of the Loom. He has a railroad that he's done. He had Apple for a while, but he didn't get out of Apple here recently. So it's a pretty hodgepodge mix of stocks. But could he sit down and explain what he's doing? Probably so. He used to say, "I don't buy tech stocks," but obviously he bought Apple, so he changed his opinion on that. So another good one is Bill Miller, not the barbecue guy, but the other Bill Miller. He's very articulate in his strategy and very, very interesting. He's a very concentrated portfolio. He likes to hold 10 stocks. So if one of them's wrong, it can really destroy him, but he's really articulate. Ken Fisher, Ken Fisher's like the permanent bull investor. Markets are always going up a bunch, but you can still read it. So it's good to read these because it starts making you think about what you did in class. How do I apply this to actually execute a decision? That's what you want, right? It's not multiple choice. It's like, what can I actually do to make a decision? So I would recommend get something down, go find one you really like. All right, so let's get into derivatives. If you don't have something in front of you to take notes, I don't know why, always bugs the heck out of me. It is possible I might say something intelligent. You never know. It's happened before. But if you don't take notes here, you're in a lot of trouble because this is something you want to definitely be taking notes on because this is a big part of the final exam. So derivatives. Y'all have heard of derivatives? If someone on an interview asks you what a derivative is, could you define it clearly? I don't think we talked about them all in our class, did we? 3013, we didn't even bring them up. I'm a huge derivative fan. I love derivatives. I bought a lot of them in the USA just because I just really love them. But a derivative is a security. So it is a security. Not all of them are securities, but the main ones we're going to talk about are securities. So they're traded on public markets, but they don't get their value from themselves. They get their value from something else. So a derivative on Apple, its value is going to be based on the value of Apple, not the underlying derivative itself. What can you get your value from? It can be from another security, it can be from a benchmark, from an index. They're getting really, really creative out there. I've seen weather derivatives, weather swaps. So you change money depending on how many inches of rain hit. So if you're Disney and rain kills you, and you do a derivative of a farmer where no rain kills you, then Disney says, hey, if we get too much rain, you pay me. If we don't get enough rain, I pay you. That's pretty good, right? They're both hedging their risk. So they've gotten pretty crazy in these things. The nice thing about derivatives is there's only two of them. There's options and futures, and that's it. There's no other ones out there. So it's not like there's millions of these things. Options give you the right to do something. Futures require you to do something. So that's a pretty big difference, isn't it? You have the right to do something, but if you don't have to, future, you have to do it. Options include swaptions. We'll talk about swaps here. Insurance, auto insurance is an option. You're right. We already talked about this before. We're paying your mortgage off early. Remember, we talked about this being an option. You have the right to pay it off early. Will you pay it off early if your coupon is much lower than current rates? No, you'll just let that option expire. Y'all remember how much you have to pay for that option? About 25 bips. That's what the theories say. So you're paying an extra 0.25% mortgage rate for that right to pay it off early. But if you get your mortgage at 3% and rates rise to 7%, you'll just, hey, I'm paying extra 25, but that's fine. I had the right to pay off early. So it gives you the right to buy or sell something in the future at some stated price. Futures include swaps and forwards. I've never used a few futures. I've used a lot of swaps. I'm a huge swap fan. If you take my risk management class, we show you how to use swaps to actually manage risk. It's a really, really cool thing. It's like magic. Boy, I love swaps. But it gives you the obligation to do something. So if you buy futures, you're obligated to do something. Usually futures and swaps and forwards, it's essentially the same as buying the security, but just in an indirect way. So if you buy futures on the S&P 500, it's going to look a lot like if you had just bought the S&P 500 as an index fund. So futures are really just another way to get into the cash market. So we talk about the cash market and the derivatives market. The cash market is when you buy something directly. If you use the futures or options, you can somewhat buy things indirectly. All right, so swaptions are options, swaps are futures. On my CFA exam, we had one entire book. All they did was prove that swaps were mathematically equivalent to futures. I don't think they asked a single question on that book, but boy, I read it in detail backwards and forwards. I thought it was a really cool book. And then I couldn't do that today. I have no idea what they said. It's been so long, but they're essentially the same. Forwards are really futures that aren't securities. They're not publicly traded. Y'all know what OTC is, anybody? Over the counter, yeah. So over the counter, that's what a forward is. It's between a sophisticated buyer and a sophisticated seller. All right, so an important term is the term notional value. Really hard term to express, but notional value is not market value. Notional value is the value that's going to influence what your stock does. So if you have options on Apple, the notional value is going to be whatever Apple stock is trading at, times however many positions you have. So notional value is your true exposure. So it tells you what your exposure is, but it's not the market value. So the first swap I did at UTSA, I remember calling a guy. First time I ever done one I was kind of nervous, never done that before. And it took us like 6 months to get the contracts done. Swaps are really messy for lawyers. But I said, I'm ready to execute. Let's do it. 5-year rates are like at 5.25%, which is pretty high. We were doing a swap that if interest rates fell, we would make a lot of money. So I said, let's execute. And he was like, no, give me a few minutes. I think I can get a better entry point. I was like, do it, hurry. I was getting nervous. Well, when I entered that swap, the market value when I entered it was 0. The second I entered it was 0. So what did accountants put on the book? They got to put something there, but the starting market value is 0. However, the transaction was like a $3 billion investment in short bonds, which means the market value of that swap was going to move as if I had shorted $3 billion in bonds. So if those bonds went down in value 10%, I was going to make $300 million. They went up in value 300 million. I mean, 10%, I was going to lose $300 million. All right. So it's a really, really incredible thing. Banks use these all the time. If you're interviewing with banks, I would definitely go look up balance sheet immunization or take my risk class if we get into that. So it explains what your exposure is to something, but it is not your market value, but it's going to determine what the market value is going to do. It's the reference number that you're going to use. So if you buy $1 million of S&P 500 futures, your starting market value is 0. But if the S&P goes up 10%, your market value is suddenly going to be $100,000. So it's going to feel like you own the S&P 500, but you actually don't. Which means these things can be incredibly dangerous, right? Because they count us like, hey, we don't have anything on the books. And then suddenly you got $100,000 on the books. I mean, the swap I did, it was zero. In 2008, it went well over $500 million. So we paid zero and we made 500 million bucks. What could it have done also? If interest rates had risen, we could have lost $500 million. But the accountants put zero on the books. Everybody's like, well, there's nothing there. Well, yeah, there's something there. This is something that can move dramatically. How much notional amount value is there out there? I don't know if I can get this to copy or not. I don't want to click on it because it'll take me somewhere besides Chrome. It's each site. They always keep changing these sites. So this is a great website. I don't know if y'all can see it. Visualcapitalist.com. All the world's money and markets in one visualization. This is a really, really great site. Have any of y'all seen this before? Who has? No? Olivia, have you seen this before? No? I mean, look at this thing. All right, silver 43.9 billion, cryptocurrency 244 billion, military spending, US budget deficit, coins and banknotes 6.6 trillion, Federal Reserve balance sheet, that's pretty unusual. The world's billionaires, they're worth 8 trillion. World's gold, that's 10.9 trillion, which is pretty interesting because people talk about US debt. I wish the US government would do a balance sheet because they've got some pretty significant assets, don't they? They own buildings, they own land, they own gold. That's $10.9 trillion that we don't ever see. I wish they would do a balance sheet, it'd be pretty cool. Here's the Fortune 500. Here's the stock market. You can see how large they are. Here's the money supply. Debt, did y'all know debt's bigger than equity? A lot of people assume equity is larger, but debt's much larger than equity. Real estate is larger than debt. Did y'all know that? Real estate's huge. Global wealth obviously is going to be large. So what comes after all of that? What haven't we talked about yet? Derivatives. How big are derivatives? 558. What's that word right there? Trillion. $558 trillion. What's the value here? Is it the market value? That's the notional value. What's the market value? It's 11.6 trillion. So you can see the notional is not the same as the market value. But how is that market value going to change? It's going to change at some percentage of what the notional amount changes. But how can you have 558 trillion in derivatives where the world economy is, I forget what they said up here, but the world economy is, where was it? 360? How can derivatives be larger than the entire world economy? World wealth, not the entire wealth. And then they do it as a picture. So yeah, it's just amazing. So, and then just notional value, that's the high-end instrument. I don't know what a quadrillion is. I guess it's 1,000 trillion. Who knows? Why don't they know? Because a lot of them are over the counter. So we really don't know. Now that's a little exaggerated because I did a swap where if interest rates fell, I made money. But on the other side, what are they going to do? Interest rates rise, they lose money. So it's essentially going to be a wash. And so this is somewhat double counting, right? So you have both sides of the transaction, but it's a massive amount of money. It's just huge. So I love that website. Really interesting stuff. So the underlying, so that's the second thing. The notional amount is what's going to determine how much you go up or down. The underlying is whatever that notional amount is, that notional value is tied to. Could be a stock, could be an index, could be a commodity. There's oil futures, obviously. Interest rates, we'll talk about interest rate futures here. You have to be really, really careful with interest rate futures. So a lot of people go backwards. There are inflation derivatives. They're not very liquid. We looked at them when I was at UTSA and we thought, wow, that'd be a really good investment. And we asked what the notional was, and it was like puny. It was just too small. We couldn't do anything with it. Currencies might be the largest out there. Currencies are just trillions of dollars every day. People are hedging that. And then we have weathers. We even have UTSA invented this one. I remember that the actuary who did that. USA invented the first catastrophe bond. You can look it up. Just type USA and cat bonds, and you'll see when they created that. It's essentially a bond that pays you depending on hurricane or earthquake losses. I mean, it's a pretty amazing thing. There's life insurance, social impact bonds. I don't know if y'all have seen that, but have you ever heard of social impact bonds? Make a great paper for a class. So let's say a city has a city jail and someone comes in and say, hey, we have this program so that your readmission rate will drop dramatically. And so the city says, wow, if we do that, we're going to save a lot of money. So they go out to the bondholders and say, hey, we're doing this program. If we drop our readmission rate down, we're going to pay you 8%. If we don't, we'll pay you 5%. Now, why can a city pay them 8% if it's successful? Well, they're going to have a whole lot of extra money. If they're not successful, they don't have that money, so they pay at a lower rate. So you as a bond investor, you're essentially betting whether or not that particular program is going to work or not. Could you do that with global warming? Definitely. There probably are global. I think there's a really fast growing group of global warming bonds. So yeah, we're getting interesting. Finance can come up with anything. There's an excellent book I read where he was talking about how the market develops these things, and it was really fascinating. I need to find it because I need to put it on my reading list. When does the market offer one and it works, and when does the market offer one when it doesn't work? And the most important thing on these is you really need hedgers on both sides. Catastrophe bonds are kind of a strange one, but you really need, if you got interest rate futures, you need people who are injured if rates rise and people who are injured if rates fall, and two of them get together and they each hedge their own risk. So you really need people on both sides. That's why inflation has been so tough. It's easy to find people that are harmed by higher inflation. It's a little tougher to find people that are harmed by lower inflation. Now, you could say governments or utilities maybe, but it's really not that big of a deal. Especially, right now, well, the federal government has indexed so much of the tax code. Inflation tends to help them more, but it's not a complete obvious connection. All right. So some good resources. CBOE is a really good resource. They have a lot of videos, they have tutorials, they have the Black-Scholes pricing model on their site. Really good stuff. What does the C stand for? Chicago. Yeah, I'm going to try to get to Chicago next year and visit Eric. He's one of our option traders in Chicago. Really cool stuff. Khan Academy, if you ever use their stuff, I don't know if these links still work, but he talks about options and futures and does, his video is about 5 minutes long, so he keeps it pretty short. Options Strategic Investment, this book, Options as a Strategic Investment. I've never read it, but it's been recommended so many times that it must be good. I need to get it and read it. This next one, Trading on Corporate Earnings News, is a very good book. It's very short, very well written. It talks specifically about straddles and strangles, which we'll talk about. And then there are podcasts out there. I have not listened to these podcasts, but there are podcasts out there. So there's plenty of resources that you can get into. This could be your entire career. There are people that their entire career is just doing derivatives. And it could be really specific. You could be doing pork belly futures, and that's your whole career. You could be doing soy or whatever. I mean, I can't remember. If you go out to FinViz, it'll list the most common ones. But yeah, so there's a lot out there. We do have a class at UTSA. I don't know when it's offered. The negative of these classes is they tend to focus too much on the option pricing models, which you probably won't really be doing. If I'm buying an option on Apple, I'm not buying it because I think the option's mispriced. I'm buying it because I think Apple's mispriced. And I somewhat trust option markets to get it somewhat correct. There's things I'll look at to make sure I'm not getting ripped off. But talking to Eric from Chicago, he says, well, if you're a retail investor, just be assured you are getting ripped off. It's just the nature of this market. You will not get a good price, so you just better be right because you're paying probably 10% more than you should. All right, let's talk futures. We're not going to do much with futures. I don't like them as much, although I do love swaps. But futures forces you have to do something. The only way to get out of that requirement is you got to close the future down at whatever the market value is. And as I said, FinViz has the most common ones out there. Let's do an example of oil. So the spot price is what you could buy today, but in 3 months, the future price is 102. So you have a choice. You can buy oil today at $100, store it in your backyard. You got a good sized backyard. Or you cannot buy oil at all and just enter a futures contract, which means you're gonna have to do what? You have to buy oil in 3 months. You have no choice. And if you forget you have this contract, what's gonna happen? The truck's gonna drop it to your house and give you some barrels of oil. So you better exit this contract a day before expiration if you don't want barrels of oil showing up. I doubt that's the way it actually works, but. All right, so which would you prefer to do? If you do the spot price, you've got two things going against you. First of all, you got to store that oil. How much would it cost you to store oil? How many oil barrels could you get into your garage? And what would your neighbors say? Doesn't sound like it'd be too good, right? So you probably have to go somewhere unless you're just buying 10 barrels. And what's that? I mean, that's kind of a waste. The second thing you have is that if you buy it all today, you're out the cash. You got to send them the $100 for the oil. So you don't have that cash that you could have invested somewhere else. What if you do the future where you don't have to store it? So there's no storage and there's no cash out front. Remember, the market value is zero. So when you do a futures contract, there's no cash that changes hands. You may have to put aside, or you will have to put aside some margin, but at USA, I never cared about margin because we had a massive portfolio that I could just go and say, hey, I'll go to Donna. Donna, you have some bonds you're not going to sell in a while? And she said, yeah, I got like 20 billion of them. Okay, well, I need to borrow a few of them for my margin. I mean, it's not a big deal. For small investors, it's probably a much bigger deal. So which is better? Well, it depends on what. How much does it cost to store it and what interest rates are? If interest rates are really, really, really high and it costs you $10 to store it, which would you do? If you need oil in 3 months, would you buy it today for $100 and store it? Or would you use the futures contract? It costs you $10 to store the oil. Interest rates are really high. What would be the smart move there?
Futures.
The futures, yeah. What if interest rates are really low and it costs you 5 cents to store the oil?
Buy today.
Buy it today, store it, not going to cost you much, and then you can sell it for 102 and make a fortune in the future. All right, that's the normal situation. That's what we call contango. Contango is the spot price is less than the future price, and that's because of what we call cost of carry. I've heard students say the future price is a forecast of prices, but more important is the cost of carry. Now, if I'm doing the S&P 500, what's the only cost of carry of the S&P 500? There's no storage, is there? So it's only that time value money, right? You buy today, you're buying the future. So there, it's only interest rates. That's all that matters. All right. So if it costs you $1.50 to store, and the time value money, you're going to lose 50 cents by buying today versus waiting. It costs you $2 to store, and time value. The futures is 102. You're indifferent, and that's what the price should be. Especially if the spot price is 100 and the futures is 105. Well, you buy as much oil as you can, store it for $1.50. You lose 50 cents, but then you can sell it for 105. You got $3 locked in. That's too good to be true. How often does that happen? Never. Right? Because that'd be arbitrage. Tiana, do y'all need the? Can y'all close the window? Is that starting to bother y'all?
Oh, it's okay. It's fine.
Yeah, it's coming right at me, but okay.
Do you want
I wouldn't mind. I like the sunshine, but thanks. I mean, now that it works, we might as well take advantage of it. Gracias. All right. Well, let's go the other direction. What if the spot price is 100 and the futures price is 98? You would probably think that never happens, but it actually happens all the time. And you know what? Anybody know what that's called? It's not contango. Any guesses? I don't know exactly how many syllables it has. I always say it backwards, but backwardation, y'all ever heard of that? Sometimes I call it backwardization. I put an extra syllable in it. Now, can that happen? Yeah, because if you think about it, to get that, so this is 98 and this is 100. The benefit there, you'd have to short oil and buy the futures. So you short the oil and get $100 a day, and then you buy it back at 98. The problem with that is, how do you short oil? It's really, really hard to do. It's kind of like trying to short your neighbor's house. hey neighbor, I want to sell your house today because I think it's overvalued. It's like, good luck with that. You can short stocks, right? You can sell stocks that you don't own. You can short bonds, but shorting commodities. So oil, we will be in backwardation quite frequently. It's actually interesting. I'm not an expert on futures, but it's quite interesting to see when are oil prices in backwardation, when are they in contango, and there's a relationship that related to, there is some predictability of what the market thinks prices are going to do based on that. So here they are. Contango is a normal. Backwardation is frequent. It's not all the time, but it is frequent. So if you can do futures or forwards, this is the kind of stuff you would have to focus in on. To me, swaps are very, very different. I like swaps because they're a lot easier for me to understand, but take my risk class and I'll show you how to use them. They're actually pretty cool stuff. So I'll give you some examples here, but essentially what this is saying is comparing the cash market to the future market. If markets are efficient, you should end up with the exact same gain, no matter which you do. It shouldn't matter. So y'all can read through that example, but it doesn't matter if you do the futures. So essentially the futures is just another way to get into the cash market. Yeah, you don't have to store stuff. You don't have to pay. You don't have time value money, but that's going to be reflected in the prices that you can get. And so we won't go into it, but you can read these examples. They're fairly straightforward. Now, can you do futures? It's not that difficult. If you have a broker, they'll let you do it. You better know what you're doing. If you sell S&P 500 futures, what's the most you can lose? So you lose money as the S&P goes up. How high can the S&P go? Yeah, you have an infinite exposure. So don't. Now, if you buy futures, what's the most you can lose? Well, you can fall 100%, but remember you invested $0. So if your notional amount's $10, the most you can lose is $10. If your notional amount is $1 million, even though your starting market value is only $0, you can lose a full $1 million. So yeah, you got to be very, very careful. That page just compares the two. What's the difference between futures and forwards? Futures are standardized contracts. Forwards, including swaps, are over the counter. This is one reason I love swaps. My swap dealer goes, okay, here's the options we have. And he had this 0 coupon 30 years swap. I was like, wow, that's what I want. I get a lot of duration and I don't have to do the quarterly cash transfers. Yeah, let's do that. It's a 5-year swap, but using a 30-year treasury as my underlying. Notional was like $3 billion. So I set all that up, go over to the accountants. They're like, we've never done this before. What do we enter? I was like, I don't know. My boss came to my desk with 2 massive books on how to account for derivatives. And he said, you need to read these. It's like, yeah, I'm not going to read those. Fortunately, USAA hired an accountant from one of the big firms that had done this his whole career. So I just went to his office and he says, bottom line, this is what it's going to look like. I said, I can live with that. It was wonderful. So we did it. Most futures cash settle. It's physical delivery is not that common. You don't want physical delivery, right? So as long as you get out of the forward the day before. So if your future is up $100,000 and you bought the future, all you have to do is sell it, go short on it the day before expiration. You'll get all your money and you don't have to worry about delivery. I don't know. There's probably some stories out there. I never looked them up, but people forgetting about expiration and something shows up at their doorstep. That would be kind of interesting, especially pork bellies. Might be a little embarrassing to your neighbors, but most are cash settled. That's also true of options. Most options are cash settled. Most people, when they enter these, they don't actually want to execute the transaction. They prefer to get the cash out. All right, any questions on futures? I'd recommend you start trading them in a paper portfolio and just start learning how bad you are at it. It's not easy. It's quite complex. You can't do forwards, but I will tell you, Bloomberg, especially on swaps, Bloomberg has an excellent swap function. The first swap I did, my trader, he sent me a Bloomberg link. He had my swap set up. And I could run scenarios, and boy, I came fixated on that thing every single day. It's like, oh, I'm up 10 million. Oh, I'm down 5 million. Oh, I'm up 20 million. Oh, I'm down 3 million. It was like every single day watching. I think I got so fixated on it. There is one huge risk with forwards that you don't have with futures, with forwards and swaps, and that's called counterparty risk. We'll talk about that in my class. But if you had done a swap with Lehman Brothers in 2008 and you had this huge gain, there's a good chance you wouldn't get your money back because you're entirely dependent on Lehman being able to pay you your money back. They do have collateral, but if you have $2 million collateral and suddenly the market moves and now your gain is 20 million, Lehman Brothers is probably not going to add $18 million to your collateral if they're bankrupt. So you do have that counterparty risk, which is just credit risk. We talk about that a lot in my risk class. It's a pretty big risk that you be careful of. You don't have that problem with futures because they're traded exchanges. There's a lot of rules. It doesn't mean there's no risk, but it's managed by their brokers. So it's not an issue. I don't think the federal government would allow the CBOE or some major derivatives channel to go insolvent. It would be pretty crushing. All right. So, okay, so options. I love options. All right, this is a big part of the exam, so make sure students are getting better and better at this over time. So an option is the right to do something in the future, but not the requirement to do it. The right to buy something is called a call. The right to sell something is called a put. When you buy auto insurance, you're essentially buying a put from Allstate. What is Allstate saying? Hey, you have the right to sell your car to us at cash value in the future. When would you sell your car to Allstate? When you've been in a major wreck. So insurance is essentially a put option. I don't think actuaries use derivatives mathematics to price their products, but you certainly could. So the right to buy something is called a call. The right to sell something is called a put. You do have to be careful on one thing, and especially on the futures. If you're buying interest rate futures, always think in terms of price. All right. So if you think interest rates are going to rise, you don't want to buy futures on treasuries. You want to sell them because it's not, you're not buying a future on interest rates, you're buying a future on treasury prices. And what do treasury prices do if interest rates rise? They fall. All right. So be real careful. People get real confused. Oh, I'm buying treasury futures because I think rates are going to rise. Like, well, no, you should be selling treasury futures. You think rates are going to rise. So be real careful. It's all based on the price. The underlying is not interest rates. The underlying is the actual price of the bond. Okay. So does that have any value whatsoever? So let's look at it. Boy, I'm trying to think of a stock that's moved here. Well, you should look at GME, GameStop. Their options are insanely. I mean, when I saw GameStop was just ridiculously high, 400 bucks. I thought, well, wow, this would be a good time to do some options. But the options were so ridiculously mispriced. It's like there was really no opportunity there. You would have lost a lot of money. So I'm trying to think of a stock that's moved a bunch. I guess Nvidia. So let's try that. This is a stock that is zoomed up here recently, pretty dramatically. So you look right over here, it says options. Hopefully Yahoo Finance hasn't changed their site, but they keep changing their site. There's an expiration. That expiration is this week. You want to buy an option this week? So this is a stock that's trading for $317. Do you want to buy a call option that gives you the right to buy it for $470? What's the chances Nvidia is going to get to 470 by Friday? Highly unlikely. How much does that option cost you? Essentially nothing. You can't actually do the trade. You notice all of these are a penny. And they're really not, it's not like you could sell that and buy that. It's just, those are just misstated prices. But, and there are people out there, there's a lot of people with this one right here. Obviously, they made a mistake. What about the right to buy Nvidia for $110? That sounds really good, but how much do you have to pay for that? You have to pay $207. Well, what is that? $318? What are they trading for? Would you pay $207 to buy this stock for $110 when it's trading for $317? You don't get anything, would you? Be kind of crazy. So that wouldn't make sense. But what if we go out into the future let's go out to March. Go out to the future. $450, look at it now. Would you be willing to pay $7.25 for the right to buy NVIDIA for $450 when they're currently trading for $370? What if next year they're trading for $440? What's going to happen? Would you execute this option? Would you? Well, think about it. You can buy them for $450 with the option. You can buy them on cash market at $440. What would you do? Would you actually execute? Would you execute this option and buy it for $450 when it's trading for $440? No, you just let it expire worthless. Okay. What if NVIDIA is trading for $455 next year? Would you execute it then? You can buy it for $450. You can turn right around and sell it for $455. But did you make money?
No.
You made money on that transaction, but you lost money here, right? Because you paid $7.25 and you make $5 there. What if it's trading for $500? You buy it for $450, turn right around and sell it for $500. You make $50. How much did you invest to get $50? Just $7.75. That's a huge return. That's even higher than the return you would have gotten if you just bought the stock. All right. So let me see if y'all can. So let's look at Apple. Apple's trading for 161. I'm not very good at this, so I'll see if y'all are. So someone says between now and next March, I'll give you the right to buy Apple for $190. How much would you pay for that? 25? 29? What if I told you Apple's going to make a huge announcement in the next 3 weeks and we don't know if it's positive or negative? Would that make you more excited about it or less excited about it? Could be great news, could be horrible news. It would make me more excited. And why is that? Greatly increases the chance they're going to be trading really high. It could be really low. But what if I tell you this stock's just not going to move much at all the next 6 months? Well, why would I do it? I forget what I asked. What price did I say? 180? 190. So let's go to 190. Oh, did it not go to March? Come on, Yahoo Finance, you can do it. Yeah, it's still not giving us the. So just go to March. If it's 1 penny, I'm going to cancel class and go buy 80,000 of those. So 190. Would you pay $2.35? 190. That sounds like a pretty good deal, right? Apple's stock's been doing really well. Or is it? I mean, that's the thing. It all depends on the volatility, but it also can depend on your view. If you think, well, Apple's got this new thing coming, boy, I think the market's really going to love it. I could buy the stock, but if I buy the option, the worst you're going to do is lose $2.35. But if you're right and it really takes off, well, you can make 100%, 1,000%. I've had options that have moved 40,000% in one day. I mean, it's just amazing. These things can move really rapidly. All right. What about selling Apple? What if I gave you the right to sell Apple for $140? How much would that be worth to you? You want to guess on that one? $140. So I was about $30 too high and it was $2. What would it be if I'm just $20 below? It sounds like it probably should be a little more expensive, right? Any guesses on that one?
$42.
42. All right. What did I say? 130? 120? It's cheaper. Why is it cheaper? We'll have to talk about put call parity here. So can you get an intuition for what these puts are doing? So you notice these calls are in the blue and then they're in the white. Where do you notice the break is? Stock's trading for 161. Where's the break? Right at 160. Here you wouldn't execute the option. I mean, here you would execute the option. The right to buy it for 160 and it's currently 161. Here you wouldn't. If this was expiration and it's trading for 161, you wouldn't do the 165. Up here is called in the money. Down here is called out of the money. Same thing with the puts, but just opposite. If the stock's trading for 161, you have the right to sell it for 160. probably not something to do, but a stock's trading for 161, you have the right to sell it for 165, that has value. What do you notice about the price of the option? The put option goes up as the strike price goes up. What do you think the call option does as the strike price goes up? Exact opposite, right? As the price of the stock goes up, the option comes down. So it does an option. We say an option always has value. Someone says, hey, you have the right to do this, but you don't have to. It may be worth a fraction of a penny. But, you know, I mean, if someone came to you and said, over the next year, if Apple hits 190 bucks, you can buy it for, if it goes above 190, you can buy it for 190. And they said, but it's only trading for 160 now, so I'll give you all the options you want for free. Would you take that? Boy, I would do that as much as I'd do 1 trillion of them. But they're going to ask for a price, right? Because, boy, they could lose a lot of money doing that. It is a positively skewed distribution. Part of that is when firms pay dividends, their stock price falls. So that helps to put options and hurts the call options. But we also have a tendency to think things go up more than they go down. So there's some skewing. But, you know, you can certainly model these things. That's why the CBOE is so good. They let you put in your own assumptions and model these things. All right, so what drives an option price? So just memorize this forever and ever and ever. It's really easy. We call it Texas video. The first class had a different term. I won't tell you. It's not quite as nice as Texas video, but Texas video. So you're trying to figure out what was that option worth, that Apple option at a strike of 180 or 140, and there's 6 things that influence it. I don't have them in order because I wanted to spell Texas video. So T is time. Now, do you play baseball or do you go bowling? Because there's an influence here. Which do you do more often? Bowling. So when you knock all the pins down in bowling, what's that called? A strike. How do you put that on the screen? X. So that's a strike is an X. In baseball, the pitcher throws a perfect pitch. What do we call that? Strike. How do you write that down? A K, right? Isn't a strike in baseball a K? Right? Carlos? Yeah, in baseball, I'm just telling you because when you look at these option pricing models, sometimes you see a K and sometimes you see an X. I don't play baseball or go bowling. So, you know, obviously, well, y'all got me really intrigued now. Strike in baseball, K. Denoted by K. All right, so I wasn't, boy, y'all made me think I'm dreaming this stuff. I did play baseball 40 something years ago, Little League, but it's been a while. Ever since I dislocated my arm, like baseball is like the worst thing. All right, so that's the strike price. The S is the price of the underlying thing. So in this case, Apple's price was 161, so the S is at 161. V is volatility. How volatile is the stock? But it's not how volatile the stock's been historically. It's how volatile it's going to be during the time of the option. So that's, you're going to notice that's the only really true futuristic thing. The I is interest rates, which right now are having very little impact because interest rates are so low. But interest rates can have an impact. It's the same type of thing we started talking about with futures. If you do options on Apple, you only have to pay that $2.35 instead of paying the 161. So it's that time value. It's the opposite on the puts. And then the D is dividends. As I said, if a firm pays a dividend, then that's going to reduce the stock price. It's going to be favorable to the put. And it's going to hurt the call. So that has to be in there as well. The initial Black-Scholes model did not have dividends in it, but if you go to the CBOE, they do have dividends in their model, and you can adjust for it. Now, what you really should do is go get the Black-Scholes model and put it into Excel. It's a really simple formula once you get it all lined up. The N are just some normal curves. You got those in Excel. There's probably a video to show you how to set this up. I set this up at UTSA because we were hiring executives from firms that had options. And USA is not publicly traded, so they didn't. So USA wanted to say, how much do we have to offer this person to get them out of their options? Because if they leave, they lose all these options. And so I had to sit down and try to figure that out. So I actually plugged this just before CBOE had their formula online. So this is the price of a call. And give you all the pieces. So ST, what do you think that stands for? We said the S was the stock price over time. The K, strike price. E to the negative RT, what is that? Yep, y'all had that in the class, haven't you? E is like continuous interest rates, right? So that's the interest rates. R is the interest rate itself, but E to the minus RT is the actual interest rates over time. What about sigma squared? What is that? That's the volatility, right? T is time. So everything I just mentioned is in here except for dividends. We don't have dividends in there. So you'd have to figure that out. So that's a call option. A put option is not in here. Where's Wikipedia? They're deriving the formula, which I don't think you need to do that. But the call and the put, the formulas are real similar. I used to have these formulas memorized when I was doing the CFA exam. I couldn't do them today. It's been just too long. But for the exam, I memorized them. The reason I memorized them is that the formula tells you how things move. You can just look at the formula and see. But those ends in these formulas are essentially a normal distribution. So they're somewhat assuming this normal distribution, and they're just saying, you know, it's the same thing you talked about. You know, what's the probability of a 2 standard deviation event? That's why standard deviation comes in and all, you know, so it's kind of basic math. Now, we didn't need the Black-Scholes model to price options, because when they developed this model, we were already trading options. So he wasn't trying to figure out the value of options. He was trying to figure out how people were getting the value of options. So it's not like he came up with this and somebody said, oh, now we know what options are worth. No, he built a model that would match what options are actually trading for. Which is kind of interesting, right? Wouldn't it have been better he come up with a model says this is what they're truly worth, but he didn't do that. Or they didn't do that. They may both still be alive. And one thing we will talk about, which I think is the most interesting, I don't see it in this particular one. But they do have it. And that is put call parity. So I'm a big fan of put call parity. You really should learn put call parity because there's a lot in that. So we'll talk about put call parity. I'm going to try to actually show you one in class, but boy, it's hard to produce one. But what put call parity means, this is the best way to think about it. If you buy a call and you buy a bond that matures at the strike price, that's what that DK is. So it's the present value of the strike price. So you buy a call and you invest in a bond that is exactly going to mature at the strike price. That will be exactly the same as buying the put and buying the stock. Exactly the same. That's put call parity. What does that mean? Well, what if you can buy this for $98 and you can buy this for $100? What would you do? We know at expiration, they have to be equal. This is 98 bucks. That's 100 bucks. What would you do? I would buy 980 billion of that and sell $1 trillion of that. And I would get $200 billion. And what happens at expiration? They have to be equal. Would you want $200 billion with zero risk? Anybody? Does that sound like a good investment? Would they let you do $1 trillion? Probably not. Let you get all your friends together. How often will that exist? It doesn't. Right? There are hedge funds out there doing that out, you know, fractions of pennies looking for that. So these markets, the strangest thing I ever saw was in December of 08, I would have done a transaction there where option got mispriced, but it was such a crazy market and I was already too stressed out and they wouldn't let me trade. That's kind of the negative of being a portfolio manager. But it was an interesting market where this thing kind of got out of whack. But it's much more complicated than that, but this is a really good theory to know. What if your regulators don't let you buy the stock? What could you do? Well, you could buy a call, buy a bond that's going to mature at the strike and sell a put. And that would be exactly the same as buying the stock. It wouldn't be any different at all. If you wanted to buy the bond, you would just buy the put, buy the stock, sell the call. Now that would be a really difficult way to get a low risk bond portfolio. I don't think anyone would do that, but it is possible. Anybody know what that's called? Instead of buying the stock, you do this. So it's a really good term. It's called replication. No, not relocation. Replication. Synthetic. Yeah, synthetic replication is probably the best way to do it. So essentially what they say is I can't buy the stock, but I can buy the call, put, and bond. So instead of buying the stock, I'm going to replicate it in the derivatives market. That'd be a cool thing to say in an interview, wouldn't it? Yeah, I was going to buy Apple, but I decided to just replicate it in the derivatives market. If you're talking to HR, they're like, wow, this guy's a genius. You need to, I can't believe what she said to me. It's like, I don't even know half the words, but you know, that's the kind of thing. How do you work that into a conversation? You got to somehow direct. So they ask you about your portfolio. Say, you know, I don't really care for the cash market. I'd rather replicate it in the derivatives market. If you're talking to an HR person, how many of those words you just said do they know? None of them, right? Now, if you're talking to a finance person, you better know what you're talking about because they will know what those words mean. All right. So don't get too fancy. But yeah, replication is huge. A lot of firms did this in 2008 and they blew up because the replicating firms were people like Lehman. And Lehman was backing the whole thing. In fact, when we talked to Lehman during that time, they're like, well, you don't have to do it through us. We have other companies we can do it through. They were already at that point early in 2008 saying, hey, if you're worried about our credit quality, you can do this other ways. But that's synthetic replication. Pretty cool stuff. Y'all getting the sense how specialized in finance you can be. I mean, it's, boy, I wish I were where you are right now. I wish I were right where you are today, but with my existing portfolio. It's kind of what I'd love to start all over, but not have to save all over again. All right. So the key here, and this is really important that you know, the strike price, the X or the K, for call options that we saw, the higher the strike price, the less valuable that call is. So the right to buy Apple at $200 is not as valuable as the right to be able to buy it at $150. So the higher the strike, the lower the option price. What about puts? The exact opposite. The right to be able to sell Apple at 200 is a lot more valuable than being able to sell it at 150. So as strike price goes up, put options go up. As strike price goes up, call options fall. The easy thing is the S is exactly the opposite. If Apple's stock price goes up, then obviously the option is more valuable, the call option is more valuable. If Apple's price falls, then obviously the put option is more valuable. All right, so they go the exact opposite. The strike harms the call, helps the put. The underlying harms the put, helps the call. All right. So if Apple's stock price goes up, that call option can be much more valuable. If Apple's stock price falls, that put option can be more valuable. And then you have the strike kind of, and you can see that in and we saw that in numbers, right? So with the call, as the strike goes up, you're seeing the option price fall. With the puts, as the strike goes up, you're seeing the option go more and more valuable with a huge volatility right expiration. Especially if we did this today, because this week is an option expiration date. Yeah, it's not. No. So, I mean, it gets really volatile. I mean, there's a good chance it's going to go down or go up $1 or $2. So, you know, it's 161 today. If you think it's going to fall, I mean, let's say I must be in the calls here. So if you think it's going to go up, that would be a pretty big rise, wasn't it? From 161 to 167, that's about a 1%, maybe not that much. What is it? But 20 cents. What if Apple were reporting earnings on Thursday? Do you think this would be 20 cents? Be much higher, right? That's that volatility piece. So that gets us to the volatility. What do options think about volatility? All of them love volatility. Call options, put options, they're always more valuable the more volatile the stock is, because it just gives you a higher chance. So we'll come back to that. Let's talk about time though. Time's an interesting one. The more time to maturity, the more valuable an option is. So you saw that Friday close, they were trading like $1 or $2. If you go out to March, they're probably going to be $20, $30. So time is makes options. The more time value, what's called time value. On the exam, you actually have to calculate time value. I'll show you how to do that. There's something called time decay. We'll talk about intrinsic. We'll get into this. I'm going to show you. Intrinsic value is really quite simple. So the intrinsic value is really what is the option worth if you were to execute the days. So here you got an option to buy Apple for $160, and it's currently trading for $161. What would it be worth if everything expired today? Be worth $1, right? You can buy it for $160, immediately turn around and sell it for $161. That $1 is the intrinsic value. So what do you think the time value is? If I tell you the time value was $10.15, could you figure out how I got that? The time value is what? The option price minus the intrinsic value. Which means these that are out of the money, this is 100% what down here? This is 100% time value, nothing but time value. You wouldn't buy Apple for $185 if it's currently trading for $161. So that entire $3.25 is time value. That time value is going to decay over time as you get close to expiration, but it doesn't decay in a straight line. It decays kind of in a hyperbole. And so what that means is time value declines really fast the last 30 days. So if you bought an option and you want to roll it forward, you probably want to not roll it forward at expiration. You probably want to roll it forward a month early. So you can get as much of that time value back, because you're going to sell that option, get a lot of time value back. You're going to buy another option that has more time value, but it's relatively, that difference is going to get much, much bigger those last 30 days. So we may talk about that when we do some callers. The other thing to be careful of is you can see why in the world did this option go up, but this one fell? Why did this one fall? And that's because it's based on the last price, but that last price is incredibly unreliable. That last price could have been at 1:30 p.m. and another one might be at 2:30 p.m. We discovered this at UTSA with the options I was doing. They were pricing them off of last price. And I would look at my portfolio and say, wow, there's no way that's correct. And the market, and especially in 2008, right? Markets are moving 10% in the last few minutes, that there was no trades. So what they did is, instead of using the last price, they started using the midpoint between the bid ask. And we'll talk about the bid ask. Mainly because the bid ask tells you what people are willing to trade at the close. Whereas the last price is just whatever price happened during the day. So we'll talk about them. There's so much here. Here's a straddle. We're going to talk about straddles. All right, so time is extremely important to an option, big part of its valuation. Volatility is the key. With volatility, it's the one unknown in this entire equation. We know the time, we know the strike, we know the current stock price, we know what interest rates are, and we have a pretty good idea what their dividends are going to be. That can surprise you every once in a while, but not too often. Now, stock splits, if they do a stock split, you're thinking, wow, they did a stock split. Boy, I'm going to make a fortune as a put. No, they don't do it like that. If you have 100 shares of options and they do a 2-for-1 stock split, they just cut your strike in half and they give you an extra 100 shares. So you can't say, well, I think they're going to do a stock split, so I'm going to buy a put. That won't work. But dividends do. If they pay a dividend, an unexpected dividend, you as a investor in puts would benefit from that. So the volatility, higher volatility increases the value. So more time increases value, more volatility increases value. The strike and the stock price go in opposite directions with puts and calls. The volatility is the one unknown. You know what the volatility has been the last 3 months, but you're buying an option for the next 3 months. And it's really important. Do they have an earnings announcement date? Is there some major thing coming up with the firm? That's going to have a huge impact. I don't care on interest rates. If you remember this, you can somewhat think of it, but higher interest rates increase the value of call options and decrease the value of puts. And why is that? Well, because you do the call option, you're paying that $2.35 instead of paying $161 for Apple. So it's saving you all that cash that you can reinvest. So higher interest rates make call options more valuable. Now, if you use the CBOE's model, they will adjust They will adjust for dividends. They have education right there. So classes, events, trading floor tours, they have all kinds of stuff that you can subscribe to. Data. They do have an option pricing. I mean, they do have an option. They call it the links. They show you all the option prices. I prefer to do that in Bloomberg. In Bloomberg, you can link everything up. So you just change your strike and it automatically updates the price, change the date, it automatically update it. Market statistics, all kinds of stuff there. There's our dashboard. The same thing we just saw in Yahoo Finance. If I am going to use a, there's the VIX. If I am going to use one online service, I'll use CBOE before I use Yahoo Finance. I just trust it better. Or maybe I should do SPY. So this will give you the SPY and it just shows you where's options, show you options. And so they bring in, this is called a chain. So they're doing near the money, but if you want to, you can do all of them. So go out to March. So there they all are. I have been many times the only volume. I mean, the only holder. So sometimes I've been, you know, this 3%. I've been this 3% before. Does that mean I get ripped off because there's no one else? Well, I still get a fairly decent price because the traders know how to do this, but it is a little scary to do that. So market data services, I forget where they have the pricing model, but somewhere in here you can, so it used to have, they used to have it. So it is in there. They just keep changing their site. So if I find it, I'll show it to y'all next week, but they do have an option pricing. They have the Black-Scholes model in their, on their site. And it just asks for TXSVID. You just put all that in there and you've got it. And they'll give you a price and then you can compare it what's in CBOE and see. Bloomberg's even better. Bloomberg will allow you to do, I think, up to 20 legs. So if you want to buy the stock, sell a call, buy a put, buy another put that's further out of money, sell a call, that's right, you can really set it up pretty crazy and run scenarios. All right, so that's it. Texas vid. Anybody do all of them? T. Time, higher time does what options? More time increases their value. What's the X? Or decay, strike price, higher strike price does what the calls? Reduces them, right? You don't want to buy Apple for 185. And so higher strike helps puts, hurts calls. The S, the underlying, higher underlying does what the calls? More valuable, right? The exact opposite of the strike. Lower underlying is puts. V, volatility, more volatility expected. Higher option prices. I, interest rates, higher interest rates is good for calls, bad for puts. And then the D, dividends. So we also use the Greeks. You know, if you're going to interview with a firm on the option side, you better know your Greeks. I wasn't a Greek kind of person. I couldn't do the math. It's just a little too complex. My option trader, he had a spreadsheet where these were all set up and I could run scenarios. So that was pretty cool. But delta, gamma, theta, vega, and rho, those are your Greeks. Delta is if your underlying changes by a certain percent, how much will your option change? So the delta is going to tell you that. If it's 1 to 1, then your Apple's up 2%, your option's up 2%. If it's highly levered, then Apple's up 2% and your option's up 20%. So that's the delta. Gamma is the change in the delta, which is really, really important. When we talk about collars, I'm going to talk about how gamma is so important on the collars. I don't like strategies where the gamma just crashes right before certain events. The theta is time, and that is how much will the option change given one more day passage in time. And like I said, If you're 30 days or more out, it's a really small number. Once you get to 30 days, that number gets pretty high. Vega is how does the option change given a change and the assumption on volatility. And then rho is interest rates, which right now is probably not a big deal. But delta, gamma, theta, vega, rho, there's formulas for all of these that are really advanced, but the Bloomberg machine will calculate all of these for you. So if you want to actually do some experimenting and look at it, they have, I think it's OMON is their option function. You can just go in there and experiment around. So, all right, so the next two classes, we already talked about that. We are going to do buying a call, buying a put. We're going to do a protected put, a covered call, a long straddle, and a short straddle probably, and a collar. We won't do spreads. I'll show you spreads. Spreads are hard to do on the exam, but on the exam, what you're going to have is you will have a long call, you will have a long put, you will calculate time value and intrinsic value, and then I'm going to give you one of these four. And you got to do that. So that's the exam. So we're going to go through those. I'm going to do it in Excel. So it'd be a good time to bring your laptop and load Excel so you can see if you can stay with me. It's fairly simple. If you understand the formula. So an option is max S minus X. You already know that, right? So if Apple's trading for 161 and my strike is 180, you have 161 minus 180. What's the max of that in zero? 161 minus 180, that's negative 19, zero's the max. So in that case, you wouldn't execute, right? You wouldn't buy Apple for 180 if it's trading for 160, that's worthless. What if your strike is 150? 161 minus 150, that's $11 minus the cost of the call, that's the gain. What do you notice about the put formula? Real similar, isn't it? The only thing you do is what? To switch the strike and the stock price. So all you're going to do on the exam is you're going to do this, and sometimes you're going to own the underlying stock. Sometimes you're going to be short something, sometimes you're going to be long something. So you do have to learn what these things mean. Protected put, covered calls, straddle, strangle, and collar. We'll be doing strangles really, but and in spreads, I'll talk through them. All right.